started. For those that don't know me, my name is Brock VandenBerg. I am the president of TaliMar Financial and the fund manager of TaliMar Income Fund I. I'll go a little about myself during the presentation, about the company, but really kind of focus and dive into the opportunity within the private real estate debt market. As many of you have seen, turmoil in the banking industry has created a huge opportunity. Rising interest rates has really driven the returns investors can earn in the private real estate debt space. Before I get too far, though, I just want to put a disclaimer out there. This presentation is for educational purposes only. This is not a solicitation to invest in the mortgage fund. If you're interested in learning more about the mortgage fund, feel free to reach out to me or submit a request through our website, and we'll go ahead and provide you the private placement memorandum and related documents as well. Again, an investment in the fund is a risky investment, and so we suggest that you speak to your CPA, attorney, or other qualified professional before getting started with an investment. So with that, let's go ahead and get started. We've got really 5 main items we're going to talk about today. First, we're going to give you a little brief overview of TaliMar Financial. I'm going to talk about where the opportunity exists in the private real estate debt market and where you can take advantage of the opportunity. I'll talk about how the mortgage fund is taking advantage of the opportunity, really how I'm investing in today's market. We'll talk about the structure of the mortgage fund. So we're going to just talk about just a 30,000-foot view of how a mortgage fund is structured and how investors earn money by investing in a mortgage fund. And if you wait to the very end, I will show you how you can earn $500. So if you stick around to the very end, I'll go ahead and disclose that $500. So real quick about myself, I am a graduate of the University of Michigan. I did grow up in San Diego, spent 4 very cold years back in Michigan, but had a great opportunity to meet some really interesting people and see a lot of good football games. So I'm excited about how Michigan is going to show up this year. I also did additional coursework in real estate finance and accounting at the University of California, San Diego. Started my real estate career in 2001 as a financial analyst at KeyBank. KeyBank had a large private equity arm here in San Diego, and I was hired on as a financial analyst, did a lot of spreadsheets, did a lot of future analyzation on values and whatnot. It was a great opportunity up until about 2007, as we were focused on working with real estate developers. Housing market slowed down, and they decided that wasn't an investment they wanted to be involved with anymore. So I then spent 2 years with the Federal Deposit Insurance Corporation. Some of you have probably remember back in about 2010 is when the FDIC started really coming in and closing down banks. Well, it was me and my team that would actually go in on a Friday night, take over a bank over the weekend, and then reopen its doors as a new bank on Monday, ensuring that all the depositors, all their money that was deposited was available to them. If a new bank was coming in, we would assist in that transfer to the new bank. If we were taking back the bank, my team would then handle the sale of any of the assets, mostly loan assets that they had in the portfolio. Great opportunity. I can only praise the FDIC. As much as we want to say the federal government is a very disorganized, inefficient behemoth, the FDIC, when I was there, ran very smoothly, very smart people that were there, and a lot of them I'm still in contact with today. So about 2008, I actually started investing in individual trust deeds. For people that are not familiar with trust deeds, it's essentially lending money out to real estate investors using real estate as security, essentially becoming the lender or becoming the bank. And that's really kind of when I got started in the industry that I am in today, and then really took it full time in about 2011, where we launched the opportunity for outside investors to invest in the loans that I originated. We then launched our mortgage fund, which is what we're going to talk about today, in 2021. I am a licensed California mortgage broker license, and I am a certified fund manager. So the American Association of Private Lenders offers courses on being a fund manager. I am certified, actually I'm certified 2.0 on their new certification. Really, it's about best practices on managing a mortgage fund in terms of accounting, finances, and then ethics as well. So this is my family. We just got back, fortunately we got back from Hawaii. It's unfortunate what is happening. Our thoughts and prayers go out to those that have been affected in Hawaii by those fires. But this is my beautiful wife, Amy, my 3 children, Scarlett, Sutton, and Sawyer. Yes, I used to have that much hair, and they let me know that I don't have that much hair anymore. So a little about TaliMar Financial. I established what is today officially TaliMar Financial back in 2000, and they really kind of started investing in trust deeds with outside investor capital around the 2011 mark. Thus far, we've funded over 875 loans, totaling over $375 million. Since that period of time, we have returned 100% of investor principal. Currently service a loan portfolio of a little over 56 million. In fact, I think that's actually low now, over 71 loans. And then we're located here in San Diego, and I have 5 employees. Here is my staff. We have Sarah Zybura, who's been with me for over 8 years, probably going almost 9 years now. Brandon Warnke, Sarah handles she's the director of operations, really manages the day-to-day operations of the firm. Brandon Warnke, brought him on recently. He's really responsible for bringing in new loan volume, has done a really good job at penetrating the market here in San Diego and the Southern California market. Kara Breidenbaker, she's been with us for over a year. She handles all the loan closing and handles a lot of the loan servicing of our portfolio. Germlin Navarro assists Kara both on the loan servicing and investor relations. And all that marketing would not have been happening without Adela Solis, who is our marketing director. So let's dive right into where the opportunity is. So first off, I want to talk about the private lending industry. So the private lending real estate industry is a multi-billion-dollar industry. And I want everybody to take this idea that it's focused on people with poor credit, poor cash flow. It's not that. Okay, we are focused on providing real estate investors primarily the capital they need to buy and manage single-family, multifamily, commercial real estate. So most of the borrowers are essentially in our fund, borrowers have at least a 675 credit score or higher, have demonstrated a track record of successfully doing transactions. It's a growing business. Well, let me take a step back to bullet point number 2. Most of the largest investment banks, Goldman Sachs, BlackRock, some of JP Morgan, all of these have their own private real estate arms. They have recognized the opportunity in the market. Number one, because it's so big. Number two, the returns they can earn and a consistent monthly cash flow, which is something I'm going to talk a lot about, that cash flow. They love this lending business. And there's a lot of buyers out there right now that are buying up these short-term real estate loans. Most of the big insurance companies now have large securitizations going on to buy up a lot of this debt. So if you're investing in individual trust deeds, and I won't get into again, I talked a little about it, but that's probably why you're seeing fewer and fewer trust deeds these days, at least good ones, because a lot of the investment banks have kind of stepped into this marketplace and are now feeding those borrowers that you may have once been funding in the past. The other issue is the turmoil in the banking industry. We saw Silicon Valley Bank, Signature Bank fail, taken over, First Republic Bank being taken over. These were banks that were really feeding into this real estate or providing the financing to real estate investors. With a lot of these with those banks failing and being bought, a lot of the smaller and regional banks have really pulled back their lending. They want to create liquidity on their balance sheet. They just don't want to be that next bank, which is, again, just grown this market even bigger for the private lending industry. Also, the rise in interest rates have really contributed to more capital coming in. Back in 2016, 17, 18, 19, 20, rates have really come down. The Fed had nearly zero Fed rate, which really hurt the returns we could really offer our investors. They were below historic returns, but with the Fed stepping in and really raising interest rates, that has brought back the interest in this private real estate debt market. And then also the rise in AI, artificial intelligence, and technology has opened up the opportunity to Main Street. A lot of this stuff really was that was financed on a larger scale, was really done by the big investment banks. And so now with the rise of AI, especially with crowdsourcing or crowdfunding, being able to people post trust deeds and stuff on the web, that's really brought Main Street into this industry. And it's changing so quickly right now. So again, I think it's consolidating away from this individual trust deed space to where investors are now pooling capital into mortgage funds like ours. So again, if people have any questions, feel free to use the Q&A button below, and I'd be more than happy to answer any of those questions. So what are the top 5 reasons why people invest in the private debt space? So number one, and probably what most people talk about, is the consistent monthly income. If you were to take an avatar of our investor, that investor is 65 years of age, most likely is retired, either had a very high-paying corporate job or was a business owner, and they're looking for consistent monthly income. They're looking for the security of real estate, and they're looking the ability to be flexible in adding and withdrawing funds. And so that's one of the advantages. Again, if you're investing in trust deeds, you're kind of stuck invested in that trust deed. But with a mortgage fund, it's more flexible. You can add funds, you can withdraw funds as you please. And that's one of the enticing things of a mortgage fund. The 4th bullet point, I'll get into this, is the 20% tax deduction on distributions. And we'll get further into this. But if you invest in a private mortgage REIT that is structured as a real estate investment trust, so it has to be structured as a REIT, the income is considered a dividend, and that qualifies you for a 20% tax deduction on that income. And that all investors are eligible. You are not capped at any type of income level. So that, again, is a big reason why investors have shifted, that invest in trust deeds have shifted over to a mortgage fund. Obviously, there's the growing opportunity. We have never been busier here in the office originating new loans. In fact, the only thing really holding us back in doing more loans is just the availability of capital and educating the general investor about the opportunity right now. And then our experienced team. So I've been at this for, technically 2008, investing my own money in what we're talking about today, and then growing the business. In fact, one of the reasons why we went away from providing individual trust deeds, so giving investors the opportunity to invest in individual loans, to a mortgage fund structure, is that we just grew too big. We've grown over 60 million in managing. That was probably over 700 investors, and trying to find a fit for every single investor in every loan that we originated was a very inefficient process, and we weren't doing our investors a service by trying to do that. So we shifted to more of a mortgage fund structure, allowing investors to pool their capital into an individual entity and then lending it out. It creates a more consistent platform for investors. So what is a mortgage fund? I'm going to quickly go over what a mortgage fund is. As an investor in a mortgage fund, you are simply investing in an entity of which that entity is the lender, lending money out to real estate investors. That money that's lent out is secured in first position. For our fund, all funds are very, every fund is a little different, but for our fund, first position on a piece of real estate, primarily residential and multifamily. Now, I always compare it to when you deposit money into a bank. When you deposit money into a checking or savings account at a bank, at the most basic level, a bank will take those deposits and then lend it out to their borrowers. It could be real estate, it could be businesses, what have you. But that's how a bank makes money. And then they take the interest income they earn from those loans and pay them back to you in the form of interest income. Obviously, over the last decade, nobody has earned any interest income on checking or savings accounts, but that's the idea. So that money that those borrowers pay on the loans that the fund lends on get paid to you in the form of a dividend. And that's what I'm talking about here. So that's the income being generated and paid to the mortgage fund and then distributed to you as the investor. A lot of questions I get is, Brock, when are distributions made? We make distributions monthly. Yes, they can be ACH'd into your account. They can be deposited directly into account. And one of the other advantages of the way the mortgage fund operates is you can actually reinvest those distributions and earn compounded interest. That's one of the other advantages over trust deeds. When you get paid out in a trust deed investment, that money sits in your account until you accrue enough to either reinvest it in another trust deed or just sits in your account. But in this case, we can actually reinvest those proceeds every month. And that's a common way, especially for people that use retirement funds to invest. They'll go ahead and just reinvest those distributions. So the structure of our mortgage fund compared to what I was talking about, which was a more traditional mortgage fund, is a little different. We actually added another step, and it's really an advantage to you, the investor. So the first thing is, number one, if you'll notice, is we have this REIT. So the investor is investing in the mortgage fund, and then that mortgage fund actually lends through the mortgage REIT. Why is that important? Well, the reason it's important is it's what gives you that 20% tax deduction on the distributions. So part of the 2017 Jobs and Tax Act, they passed this legislation within the Jobs and Tax Act that distributions from a pass-through entity, an LLC, or other type of pass-through entity qualifies you, a owner or investor in that LLC, to earn a tax deduction on the distributions. However, the problem with that legislation is that it starts to phase out after you get over a certain income level. Now, I forget what that income level is, but it's going to phase out. And for most investors that are accredited, they most would phase out. The REIT, though, because it's the money is flowing through the REIT, or the way they wrote the legislation is they carved out the REIT. So income generated for a mortgage REIT is not part of that legislation. It allows any investor of any income level to take advantage of that 20% tax deduction. That is why that we added the REIT into the structure of our mortgage fund. Now, people ask, well, is it going to sunset anytime soon? Yes, they're going to have to extend this. I wouldn't call it a loophole, but this tax advantage, they're going to have to extend it. I'm pretty confident that they will, but we shall see. All right, so I always like to use the word boring because that's exactly what I want my mortgage fund to be, as boring as possible. I don't want any problems with the mortgage fund. I want every month a distribution to be deposited in my investor account or reinvested. And that's why we take a more safe approach to investing, which is focusing on real estate in core urban markets, primarily here in San Diego. In fact, 80% of our portfolio is secured on property just here in San Diego. First position loans, primarily on residential and multifamily properties. It's going to be boring. You're just going to receive a monthly check in your account every month, and that's the idea. We're not pushing for massively higher returns, to take risk and to get those returns. We're just going to do what we know works over the long term, and that is to be focused on funding loans here in the Southern California marketplace. So why TaliMar Fund I? What is it about our fund that can take advantage of the opportunity currently in the market, but without taking outsized risk to get the returns that we have? So as I talked about before, we're really focused on core supply constrained markets here in California. Okay, I am confident, even in recessionary periods, that housing in the San Diego market is going to be relatively insulated from massive market fluctuations. Now, if we see a significant decrease in values in the San Diego market and Southern California market, you're going to see major issues generally. okay, in the economy. And whatever investment you're going to be involved with is going to probably be negatively impacted. But I think long-term, I think values of real estate in San Diego, because it's a supply-constrained market, and the markets that we're lending in really insulate the market from recessionary periods. Now, let's say worst case scenario, let's say that the portfolio of loans that we're investing in here in the San Diego market don't perform. Tell you what, again, we're probably going to be in a recessionary period, and I'd rather be secured on single family and multifamily properties and owning those properties than alternatives. So again, we are weighted towards residential and multifamily assets in the mortgage fund. We have an experienced team to originate and manage the fund. So we've been at it for 15 years, originating the very loans that we are putting in this mortgage fund. And we really dialed in our ability to quickly underwrite and assess the risk of the loans that we're putting in the fund, but then also managing and servicing that portfolio. I think a lot of people focus on, well, what kind of loans are you originating? What kind of risk are you taking? That's only 50% of what we do. The other 50% is servicing the portfolio. Because when you close the loan, you have no control over what happens to the borrower, what happens over to the real estate that is securing your portfolio. So you got to stay on top of ensuring that the payments are coming in on time, that you're comfortable with the loan scenario. If you identify issues with the borrower or the real estate, you've got to be able to manage through those issues immediately, be able to recognize it and then manage those issues. So those are when I say experienced team, it's not just about originating loans, but it's also about managing that portfolio. Obviously, we're structured as a real estate investment trust, a REIT. And so you do qualify, all investors qualify for that 20% tax deduction. And then we really rely on third-party vendors to assist us in the day-to-day maintenance of the fund. So for example, we work with FCI Lender Services. Hold on one sec here. It's one thing you learn about doing a Zoom call is make sure that your phone is on mute. So when I talked about third-party vendors, one of the biggest servicers of the private debt space is FCI Lender Services. They service debt, which means they collect the payments, they provide the monthly statements to the borrowers, and they ensure that you as a lender are following the regulations in each state that you're lending in. Now, we're in the state of California, which is probably one of the most complicated states to service a loan portfolio. That's why we outsource our the servicing of the portfolio to FCI. We've Gerasi LLP, which is one of the largest firms that creates mortgage funds, that services the mortgage fund industry from a legal standpoint, is our attorney. We've got Verivest, who does fund administration. What is fund administration? Essentially is the day-to-day accounting of the fund. So we've outsourced that to a third party that specializes in doing accounting. I do that for a couple of reasons. First, it's expensive to have a full-time accountant on your staff. Number two, they act and though they don't do an audit, they act in kind of that capacity to ensure that that the accounting is done correctly of the mortgage fund. And that's really important for a lot of investors who ask that question. And then finally, we've worked with our audit firm, Spiegel Accountancy, who does our audit and tax work at the end of the year. So we had our first audit done in 2022. Great experience to go through. If anybody wants a copy of that audit, I went ahead and posted it on our investor portal. I'll go ahead and show you how to get to the investor portal, but you can always view all the documents of the mortgage fund in the portal. So here's an example of the types of funds types of loans that we do. So we do really two types of loans. We do short-term, we call fix and flip loans. So there's loans where the borrower is acquiring a property, they're renovating the property, and then they're going to sell it for a profit, or maybe they refinance it and hold it as a long-term rental. But either way, it's a short-term loan. It's secure. Our loan is secured in first position, and the borrower is adding value to the real estate. A lot of these cases, these loans have a construction reserve component to it. So we're going to lend money to the borrower to finance the renovation of that property. Those funds sit in a separate account, and then we disperse those funds to the borrower over the course of the project. We want to make sure that the renovation is completed. Love those loans. Why? Because the borrower is adding value to the real estate. They also, our interests are aligned. They're trying to get out of the loan as quick as possible. They're either going to sell it or refinance it, which is what we like. You don't ever want to be stuck in a loan where the borrower is kind of wishy-washy about what their exit strategy is, how they're going to repay the loan. A big component of our underwrite is how am I going to get my money back out of this loan? What is your strategy? So that's why I like the fix and flip loans. It's been our bread and butter for the last 15 years. And we've funded over 600 of these kinds of loans and really done had a lot of success with this loan type. So this one was in San Diego. I'm going to show some before and after videos of a project we did as well on that. Again, another fix and flip loan. This one was in Petaluma up in Northern California. And here's an example of a bridge loan that we did. So in this case, this was a small retail strip center. And here's a perfect example of why owners and operators of these kind of small strip centers, industrial warehouse sites come to the private lending industry. This one was supposed to go to a conventional bank, but we were going right in the middle of the banking crisis, and the bank said, you know what, we're going to stop our lending right now. So these borrower was forced to go to the private debt space to get the financing that they had. Great loan, great borrower, great piece of real estate here in San Diego. It's cash flowing. And our exit is going to be a refinance at some point in the future for this borrower. And that's kind of the niche that we fill. Again, I want to get away from this idea that we're funding consumer loans, which we don't do. We don't do owner-occupied properties. And so we're focused on the investor marketplace. And what we're not is a lender to people with bad credit or cash flow. So I think our average credit score in our portfolio is north of 700. So these are good borrowers, experienced borrowers. So I want to show a before and after video here. I'm going to pop out of our PowerPoint presentation. Go to our website here, webpage here, and see if I can show you an example of a before and after. So let's go ahead and check this one out. This is a recent project that we funded, of which the borrower renovated and sold the property. So a couple of things that I show this video that I want to really focus on is, number one, the reason why the fix and flip market is so big is because the housing stock in many of the markets that we're lending in has just aged. And most of the homes that we're financing have essentially become functionally obsolete. The electrical, plumbing is shot, roof is shot, maybe they got foundation issues. Even the physical layout of the properties are old. So you've got old, these kind of old galley kitchens. Most of the homes that we're lending now, they're going to open that kitchen up to the living area to make a more open space. And that's why it's only till within the last decade that this idea of fix and flip has become so popular, and why institutional capital sources have really started to come into this market and lend money to these real estate investors. The other thing that I really like about this is, for me being in here in San Diego, is that we're really adding value to neighborhoods here in San Diego, especially neighborhoods that may have been neglected. It's these investors that really go into these neighborhoods and gentrify them and bring them back. I mean, most of these homes are just the ugly duckling of the street. They've been neglected for long periods of time. And now you've really got something that the community can look at and say, hey, what a beautiful house. Creates jobs too. So, you're bringing your contractors in, you're bringing real estate agents in, and it also brings tax revenue in from the city. So now you've increased the value of this real estate, and you're going to have additional property tax, and then all the other taxes associated, especially here in California, involved in a transaction like this. And that's why it really interests me. And I love to see these before and after videos of these projects. About 2 weeks ago, we hosted an event with investors at one of the projects that we funded in Carlsbad. Great event, opportunity for the investors to meet the borrower and ask questions about the borrower, why she uses hard money to do the deals, how she finds deals, what her long-term goals are. And it was a great event. I'm going to probably do that event again because, again, it brought a lot of interest from investors. So that was a great example of what a fix and flip loan would look like from before and after, and why I think it's a great product type to be lending on. All right. So this is something I mentioned when I kicked off the webinar. Was Warren Buffett's company invest in 3 home builders even as rates rise? And I think it goes again to the fact that the opportunity exists, huge opportunity in the residential and just the lending industry in general. We're so focused on, and I think the media is driving this narrative that interest rates are going to implode the economy. Well, they haven't. In fact, it's probably has been one of the better things to happen to the residential housing market, especially here in San Diego, because if you look at supply, it's plummeted. Nobody is going to sell their house and move to a new house if they have an interest rate at 2.5%, so that they can go to a new interest rate at 6.5%. So I think that in itself has really buffered the housing markets. And a lot of these markets, LA, Orange County, San Diego, I might take Bay Area out of it because it's got its own problems right now, but some of these other housing markets where there just isn't a supply. There isn't enough supply for the demand. And that's really buffered the housing market, really kept a floor to any loss in value. In fact, I think if you're going to see here in the next quarter some huge jumps in home prices, especially here in San Diego over the last year. And it's not just till recent. I mean, you've really seen that jump from November to December of last year. I had a lot of investors concerned, hey, Brock, where do you think the housing market's going to go? And again, I look at the empirical, I look at the evidence, I look at the numbers, I say, look, where are values going, or where are sales going? And do we see a huge amount of new homes being brought into the market? No. Are you seeing slowdown in turn times on sales? You don't. And then most important, what are you seeing from an employment standpoint? Here in San Diego, unemployment, you've got sub 3%. So you got zero unemployment. So until I start to see some of those numbers, then I just don't see the housing market really suffering. Now, that's not to say that something happens in the future, but the evidence doesn't suggest it right now. Okay. So a question comes in, what is your process if a loan goes bad? I'll jump into that. And then finish a rehab. If you do, use a related team, another borrower, or retain third party. I imagine what you're asking is, do we use a third party to view the progress of the renovations? And then on track, missed principal to end. Renegotiate and tack missed principal to end. File default. So yeah, a lot of this goes to the servicing of the portfolio, and I'll jump into that question. All right. So I talked about the team, legal, Gerasi, fund administrator is Verivest. they actually, VandenBerg, one thing I forgot to mention is they probably service 100+ funds. That is including mortgage funds, multifamily, commercial funds, and whatnot. So they really have a platform to do the accounting. Spiegel Accountancy, one of the larger accountancies that work with funds like ours to do the audit and tax work. FCI Lender Services, it's a love-hate relationship if you invest in trust deeds, but they do really do protect you from issues from a servicing standpoint. And then we're big on software, so we've rolled out an entire software platform that really is the engine of the company, and that's what runs that investor portal that you use. First position loans. So we only focus on first position loans. Our target LTV ratios is 65% or below. I think we're about 65.9%. Location is California. So we're solely really focused on in the state of California for right now. Single family, multifamily, and commercial. Fix and flip and bridge loans, not to exceed 10% of investor capital in the fund. So obviously, we don't want any one investor to have more than 10% ownership of the fund, so we try to keep that limited. And loan terms loan size too. So we don't want any one loan to be greater than 10% of the entire size of the portfolio. Loan term 12 to 24 months, and then minimum credit is 675 or above. Now, one of the questions that I'm going to jump into now is, how do you service, Brock? How are you servicing those fix and flip loans? So how are you doing the draws? And again, over the 15 years, I've tried every which way to make it the most efficient way possible, but while still protecting investor capital. And the best way that I found is this. So the average construction budget for a fix and flip loan is just shy of $100,000. And it's going to scale from obviously the smaller the house, the larger the house. And really, we've broken it down to 5 to 10 draws, and you base it upon work completed. So first draw in most cases is renovation or demolition complete. Then we say rough work complete. Now, rough work is all the wiring that you see in the wall, plumbing, so rough electrical, rough plumbing, and then rough framing. So they'll show that is completed. Now, once it's completed, we've already agreed upon the dollar amount they're going to receive. So if it's a $100,000 budget and the demolition is complete, we may say, okay, here's your $10,000, and then they can use those funds to get to the next draw or next stage. And then once they get the rough work done, again, it's another $10,000. And the draw process is relatively simple. We actually have them now. You've got apps that you can take video of the work being done, very simple, and then they submit that video into our servicing department. We ensure that the work is done. We ensure that the video that they're showing is of the property, and then we'll go ahead and disperse the funds. If there's any question about draws, or we have a question about, or may disagree with if they met the draw requirement, we may go visit the property to ensure that the work is done. But one of the big things that has really changed in the industry is the ability to disperse funds more quickly. There's a lot of technology out there that can really assist in the construction draw process. But again, sending somebody out for every construction draw on a fix and flip business or a fix and flip deal, if we're talking about interior paint has to be completed, becomes a very expensive process. So we've never had an issue with it. So I think a lot of people say, well, what happens if the work doesn't get done? And there's been rare circumstances that the work has not been done. We find that investors are going to find any which way to get the work done. If I always tell investors, I would say that in some cases, the amount of work that we have, or the amount of work that we anticipated that they were going to put in wasn't at the level at what we had. We've seen that, but in most cases they're going to get the work done. And keep in mind that these are not heavy construction deals. So we're not doing new construction loans where you're going to probably want to have a site inspection done. You're going to, go in and compare the budget of what they've spent to date to what they anticipated. So these are more cosmetic type renovations that are being done to the property. In terms of dealing with default notifications and whatnot, so I've had three foreclosures in 15 years. And again, I think it just goes to the fact that I'm really focused kind of in the San Diego marketplace, really first position loans, lower on the LTV ratios. So we really haven't had a ton of requirement for foreclosures. In fact, I think the one foreclosure was a fraud issue, unfortunately. The other was going into COVID. He just wouldn't drop his price to get it sold, but yet he couldn't make the monthly payments. So we take a very aggressive approach at servicing the loan portfolio. So if they're 30 days plus late, we'll go ahead and initiate the foreclosure process. Go ahead and record a default on the property, and then go through the foreclosure process. Now, here in the state of California, that can take 4 to 6 months, and that's assuming the borrower doesn't fight it. Most cases, they're going to either sell the property by that time because they've got enough equity, enough interest to get that money out, or go find another lender to take us out. In terms of renegotiating tacked missed principal to the end, we've never had to tack principal. I mean, I guess that's a negotiating circumstance. If the borrower can't make a payment on a loan and you tack that payment onto the back end, I don't recommend it because honestly, most cases that's going to come right back again. They're going to not make that monthly payment the next month, and then you find yourself tacking it on again, and then explaining when you decided that you've put your foot down and said, no, we're not going to do it, why you're deciding to put your foot down. I take just a much more aggressive approach. If you can't make the payment, I'm going to start a foreclosure action. And usually that puts the borrower or gets the borrower some type of action. Either they sell the property or find another lender. So that's going to answer question number 1. All related to default. How do you validate that the work submitted for the draws is that location? Yeah, so one of the requirements when you do the draw, the videos have to be from the exterior of the property, so you can match up the exterior of the property. There's also apps available that you can actually do GPS, and so it'll actually show the address of which the video is being made at and at what time. So there's a timestamp. Had a fraudulent borrower send pictures from a different project that wasn't even our own. Yes, so that is something that you really have to be super careful about. So, in my time, if you can get the video from the exterior of the property to ensure that the work is done. Also, we're already having understanding the layout of the property prior to funding. And so you can quickly tell if that's the property or not. But yes, there could be some concern. I agree with you that they're giving you photos of the wrong property. Next question is, how do you go about preventing cash drag in a fund this size? So good question. What is cash drag? So the question is, or what is cash drag? Cash drag is simply uninvested dollars sitting in your account. So if you're an investor in trust deeds, you get paid off, that money gets deposited into your account. Obviously, you're not earning interest on that money. The same idea is with a mortgage fund. When a loan pays off, that money sits in our checking account and doesn't earn interest. So you don't want a huge amount of cash drag because that brings down the overall return of the fund. So there's a couple of ways that you can do it. Number one, you can kind of create some consistency in the amount of loan volume that you have. Isn't the easiest, but that's one thing you can do. So you can project into the future how much investor capital you need for the amount of deal flow that you're going to have. But we also have a credit line. So we have a $5 million credit line with a local bank here, and that allows us to manage inflow and outflow of cash. So let's say 1 month you have more loans that come in than investor capital. So you may take money off the credit line to fund those loans. And then as new loans or new investor capital loans pay off and new investor capital comes in, you can pay down that credit line. Now, in the past, you could use the credit line to what we call arbitrage the return. So you could say, okay, my credit line is charging me 5% and I'm putting money out at 9%. Therefore, I can actually make, I could juice the return. I can make additional income by just using a credit line. Isn't the case anymore. Credit line right now, honestly, is at 9.5%. And so it about matches, or it's actually a little greater than the overall return of the fund. So you've got to just be careful about using your credit line, and you want to make sure that you do it right. So you want to make sure that you do have an exit, a way of paying down the credit line through the sale or through the payoff of loans. Okay, so I guess another question is, what did you change after the fraud? So in this case, and I don't mean, because we don't have a lot of time to go over this, but fraud issue here was a real estate investor came to us, was actually referred to us on a loan, fix and flip loan, and right at the prior to close, they had experience. They were going to close in their name, and they decided to contact us and said, hey, our capital partner would prefer to have the loan in their name, which, okay, that's fine. So their capital partner wanted to change the loan in their name. Well, about 5 months into the loan, they decided, or they stopped making payments. So we started a foreclosure action, and the borrower contacted us and let us know that they were going to sue us for elder abuse. And unbeknownst to us, well, we should have known, is that should have taken a look at the driver's license and found out that it was an elderly lady that he had somehow conned. Well, at this point, I felt like he had conned her into owning the property. Well, lo and behold, it was his mother-in-law that was the actual borrower. She had also subsequently passed away during the loan. And so he came back, found an attorney, said, okay, this is elder abuse while we go through the foreclosure process. We foreclosed on the property, but because he had recorded a lis pendens, essentially that there's an ongoing litigation with the property, it came back to us. We had to negotiate a settlement with him and pay him to leave the property. We then took the property and sold it to another investor and got all of our principal and interest. This is where it's important. Understand your age of your borrower. And this is where you really have to dial in and understand, okay, who is our borrower? Know your borrower. And that was one of the big teaching points for our organization. So another question came in: do you have more capital than deals, or vice versa? And that kind of goes back to that question about cash drag. You constantly have more money than deals, and constantly more deals than money. It's the nature of the beast. So every morning I wake up and I look at what's in the pipeline and how much investor capital we have. In a perfect world, it's matched up, but it doesn't happen. So, again, we can utilize the credit line to manage inflow and outflow of capital. Now, our fund right now is a little over 56 million in total investor capital. There is about 150 million in an available opportunity just in San Diego. So when I talk about, the opportunity for or being held back, not by deal flow, but by investor capital, that kind of gives you an idea of the opportunity we have. So I don't see the market slowing down anytime soon for our type of capital. So as new investor capital comes in, I can quickly get it out into a new loan. So do you have a limit on, so the credit line is 5 million. So I guess if that answers your question, I can go up to 5 million in terms of our existing credit line. Technically, I like to see a credit line. I think to safely manage a mortgage fund, you can go up to 20, have a credit line up to 20% and be safe. I'm not going to say that you want to be tapping 20 million at any given time, or 10 or 20% at any given time. It's just, it makes it easier to manage the deal volume that you have in order to keep out that amount of capital. So, if you have a credit, a fund at 100 million, you really ideally you want to have about a $20 million credit line to ensure you have enough, enough bandwidth to deal with swings in available capital and new deal flow. Now there's other funds out there that'll lever up to 80% and keep that out consistently just to get that small amount of arbitrage. And I would suggest that that's probably a very risky type fund to be doing that. The returns, obviously, you can get a higher return, but it's a risky way of funding. Do you have a reserve in the fund to cover foreclosures, attorney fees, or unforeseen expenses? And actually, this is a common question. It's consider a reserve, and the answer is no. So, and the reason we don't is, number one, for first position loans, it's 65% LTV, and then in discussions with our CPA, there's enough coverage in our mortgage fund that we wouldn't have to do it. And the reason you wouldn't want to do it is because, number one, it creates a taxable event for the investor. So you, the investor, may earn 8%, but in reality, you're only getting 5% because we're taking that 3% that you should have been paid and placing it in a reserve. And it really doesn't add value to you. And so that kind of reserve account is much better suited for a higher risk type investment, and then or higher type risk fund if you're going to do it consistently. Now, that isn't to say that if we recognize that we're going to have a default in the portfolio and it's going to cost the mortgage fund a set dollar of amount, or we're going to have a loss of principal, at that point, we'll go ahead and set aside funds to cover that loss. So at that moment, we'll go ahead and set aside accounts. The other thing is we don't do construction loans. So where you're going to start to see massive losses, and you really haven't seen it yet, but it could be a problematic, is a lot of like new construction, ground up construction, where you may have to step in and finish the construction for the borrower. And we're not talking like fix and flip loans with budgets of 100,000. We're talking about construction loans with $2 million budgets where, look, they may have, they may have gotten only 25% done, and you're going to have to step in or sell the project as is and take a loss. And so that at that point, you're going to take a, you'll reserve for that specific loan. Being a resident of Texas, I'll have to pay California. Oh, a good question. Being a resident of Texas, will I have to file California state tax distributions? I forgot to mention this. Because we're structured as a REIT, all right, you are not subject to California withholding tax. I'll say that again. Because we're structured as a REIT, you're not subject to California withholding tax. In fact, over 50% of our investors are outside of California, Arizona, Nevada, Florida. I think we've got we just did a calculation. I think we over 20 states that we have investors in. So yes, that's a great question. You are not going to be subject to California state withholding. That is another benefit. If you invest in trustees, you are technically subject to California withholding. If the fund that you're investing in isn't a REIT, structured as a REIT, you could be actually required to file your taxes yourself in every state that lender, or if you're doing multifamily, have invested in. So, if we were doing doesn't really affect us because we don't do multi-states, but there's a lot of mortgage funds that do multi-states, and you may be required to file in every one of those states, and it becomes super complicated. Are you seeing a buyer slowdown as mortgages cross 7%? Not at all. In fact, you're probably seeing an increase, especially here in the San Diego market, where days on market is actually declining. And I'm going to talk about that. Every month I do an investor overview of our fund, and I talk about the market. That day on market is declining, and it all is driven by supply. People who want to buy a house have to act quickly because there isn't enough of a supply to meet that demand. And that's why I say we don't have an interest rate problem right now. We have a supply problem in the markets that we lend on. These are awesome questions. Keep them coming. These are really, really good questions. Thank you for asking. I'm going to move on real quick and just make sure that, I got some more here. Does the REIT structure prevent UDFI and UBIT? Yeah, great. Gosh, another good question. So the REIT structure, what is UBTI? That's unrelated debt financeable income, or UBIT, unrelated business income tax. What that is, if you use retirement funds to invest, we've all talked about self-directed IRAs. You don't have to invest in stocks and bonds and everything that these brokerages tell you have to invest in. You could invest using a self-directed IRA to invest in mortgage or trust deeds or our mortgage fund. But the problem being is that if the investment that you're investing in is structured as uses credit or uses lending, a loan to do whatever they're doing, their activity, you could be subject to ordinary income tax as a percentage of the income generated by that debt. So if they're using debt, for example, let's say you're investing in a multifamily project, and that operator goes and gets a loan for the multifamily project, they're using debt as it relates to that investment. And you could be subject to ordinary income tax as a percentage of the debt used for that mortgage fund. I'm not going to go into like super big details, but it's interesting. Because we're structured as a REIT, you are not subject to this. You are not going to have to pay ordinary income tax on any funds that were a result of the credit line that we have. So another question is, can you explain the tax benefit REIT have compared to a normal mortgage pool? So we kind of talked about that. So the biggest advantage is because it's a REIT, all investors qualify for that 20% tax deduction. That REIT allows you, all investors, to qualify. There isn't any type of income phase out period. So that's what the REIT does from a ordinary, if you're using non-retirement funds. If you're using retirement funds, we just talked about UBIT, you're not going to be subject to unrelated business income tax. Keep them coming. Good questions. All right, but I got to move on too. So All right, so current portfolio right now, we've got 72 loans in the portfolio, totaling a little over 57 million. 700 average loan size is 798. Weighted average coupon of the portfolio, and I'll get into what this means, but this is the average coupon. This is what we're lending money out to our borrowers, is at 10.1%. So we're seeing that rate go up. In fact, all the loans that we underwrite today have a minimum interest rate of 10.5%. If you asked me that question last year around the May timeframe, we were underwriting to about 8.25%. So that's how much rates have jumped up in a short period of time. And we do not see any decline in velocity. Average loan to value ratio right now, we're at 65.53%. Average term is 14 months. And we have no late payments or defaults in our loan portfolio right now. What this table shows you here right now is the breakout of loan type. So on the left-hand side, you have bridge loans. Bridge loans are really loans that there's no value add component to it. Borrower just simply needs a short-term loan to either purchase a property or refinance an existing loan. These loans have a tendency to be longer in duration. I don't say longer in term, but a fix and flip loan usually be out within 4 to 6 months, maybe a little longer, depending upon how much renovation is required. Bridge loans are averaging us around 10 months. So they're a little more sticky, excuse me. I like that. As you grow a loan portfolio, you can't burn through fix and flip loans every 2 to 4 months. It's a very inefficient way of creating a loan portfolio. So, you like to bring in those bridge loans because they stick on the portfolio a little longer, as long as they meet your underwriting credit criteria. This is a table showing property type. So you'll notice that the vast majority of our loan portfolio is single family. And then the second largest is retail. And again, I like retail. I like industrial. I like wholesale here in San Diego because, number one, you can charge a little more for it, lower LTV ratio. Usually have a pretty experienced or knowledgeable operator, so they understand what they're buying. And then it's because banks, these local banks who usually would be lending to this kind of market have just stopped lending. So that's that opportunity there. Location, again, overwhelming in San Diego. I think that there's enough business in San Diego to do 150 million in loans a year. Not a problem. So I'm just going to stay focused and penetrating the San Diego market. Again, you can't just be focused though. I mean, at the end of the day, you do have to expand your marketplace. So I always say we're really focused in the Southern California market, but when opportunities arise up in Northern California, we'll take advantage of them. But you can also consider, like, you always question when a broker or somebody calls you from Northern California with a loan. I always say, well, why are you calling a Southern California lender? What is it about this loan that all your Northern California contacts couldn't do? I always tell my loan originators this: if somebody calls you for a loan in Beverly Hills, they've already burned through all of their Beverly Hill lenders. So there's always a problem with it, and just ask the question right away. It's like they think that coming down to San Diego, they're going to be able to get financing for that Beverly Hills property. And it's always, they need like $15 million on a high-end spec house, which again is not what we're focused on doing. All right, new loan production gives you an idea of how much loan production we're doing in a given year. So what you have here is in last month, we did a little over 7 million. Month before, around 7 million. Our goal is to do about 7 million, and we're really held back again by the amount of investor capital that we have. We could easily be doing 10 million if we had the capital available to us. And just an idea of also kind of compares with last year. What's really interesting is right in the July timeframe here is kind of when rates, well, actually it was May when the Fed really started to step in and really increase rates, but we didn't see a massive decline in deal volume from last year right until about the June, July timeframe. And if you were to take this chart out through the end of 2022, you would just see it just plummets. I mean, we had the lowest deal volume, I think, in October of last year, but then it immediately comes back in November and December timeframe. I think that's kind of when people realized that the housing market wasn't collapsing with the higher interest rates. But we'll be doing another 7, probably 8 million this month. And so kind of keeping very consistent at that 7 and 8 million mark. Historic returns gives you an idea of kind of the returns. If you looked at this time last year, we were sub 7%, probably closer to around the 7.25%. Our target yield for the fund is going to be between 8.75% and 9% annualized. That's going to be paid out monthly in distributions. Right now, we're average year to date is around 8.8. People ask, well, Brock, why was that decline here in June? We ended up having to take 2 big costs, and we went ahead and just allocated it to this month, and that's as a result of the 2022 audit and the tax work that we did. So that just dropped the return for that 1 month, but we're back right here in July. August, we're going to be probably in about that 8.8% return. I anticipate we should actually, today is the date that they'll finalize the investor numbers, and I'll announce that. By the way, I recommend, if you're interested in learning more about kind of the updates of the fund, reach out to me and I can put you on our email distribution list, and we post a ton of content, or we send out a bunch of content on the mortgage fund. So let's talk about capital raised. And this is something I just threw this table in prior to our webinar today. This gives you an idea. July 2022, the fund size was about 17 million. We broke 56 million in July. Our fund has grown by 3 times. It just shows you the amount of interest and interest in the fund, the fact that the consistent monthly cash flow, the security of real estate. And so I wanted to give you an idea. And in fact, we actually surpassed 200 investors last month as well. So our growth has been but it's been fantastic, and we anticipate this growth trajectory through the end of the year. Again, right now we're about 56 million. We anticipate our focus goal is to be at 75 million by the end of this year, and by about 150 million, which is kind of what I think the marketplace is by end of 2024. So the question is, Brock, how do you mitigate the risk of the fund? Okay, so number one, we know our market and we know our borrower. Okay, that's like banking 101. When I was at KeyBank, That's what they kept telling me. Hey, know your market, know your borrower. And that's why we really stay focused in the Southern California market. We know the San Diego market. We're looking at it every single month. What are the numbers? How many sales are there? What's the amount of homes on the market at any given time? And then understanding our borrowers. It's a small network of people that invest in single family and multifamily properties in San Diego. You know everybody. And so you know who's performing well and not who's not performing well. So we really want to be focused. We're not going to be that lender that's going to try to go off to the Midwest or East Coast and be lending. Yes, returns may be stronger in some of these markets. But you got to also take into consideration the amount of risk that you're taking by going into those markets and the fact that you just don't know the markets. In fact, if we were really going to go into Orange County or LA at any heavy level, really market, most likely we're going to do an acquisition of a hard money lender in that market or find an originator that really knows that market to be able to drive, any entrance we would be in that market. Focus on strong property types. This is really important. This is like, I always ask the question, do I want to own that property if I have to foreclose on it? If it's a single family and multifamily, most likely here in San Diego, the answer is yes. Worst case scenario, I'm stuck with a single family or multifamily property. That's why we don't do land. I've seen funds blow up that really focused on funding land. Land value is great when the housing market is strong, but when the housing market collapses, value of land goes to zero. So does the principal of your investment. So I really stay away from doing land development deals. That's why I don't do many construction loans, if at all. And I think the last construction loan I did was 3 years ago. Yes, there's demand for construction loans. Yes, you can price it, but look, it was pretty scary times back in 2022 when inflation was out of control for these construction lenders. And I still think a lot of them are still having problems trying to finish out some of these projects. So we try to keep it first position loans, understanding our assets, loan strength over portfolio yield. That's one big thing I talked to my loan originating team about. Hey, we want loan strength over portfolio yield. Question came in, how aggressive are you on the loan servicing? We are ultra aggressive on servicing our portfolio. As I mentioned before, 50% of a successful loan is the underwrite on the front end. It's the servicing that I think a lot of people forget and how important it is to be very aggressive on servicing. If they don't make that payment by day 10, we have a 10-day grace period. You've got a letter and a phone call going out to the borrower asking them to make that payment. Day 30 hit, an immediate default is going to be made. But very important. So if you invest in trust deeds, that's my approach. I recommend that approach. I find that borrowers, if they see somebody that is direct, that shows an action, they are going to either sell that property or get or refinance you out of it. Plus, dealing with a portfolio that has a heavy amount of defaults in it is very inefficient. Even if you think you can earn late fees or default interest, which in state of California is almost impossible now, it still doesn't cover the cost of managing loan defaults. It's very inefficient. Consider banks, they hate loans that are in default on their portfolio. I look at it the same way. I do not want a portfolio of loans that are in default. Use technology to identify issues early. We do that. So we have automated emails that go out to the team. If somebody NSF'd or their payment didn't clear, an immediate email will go to our team and the borrower to go ahead and make that payment. If we see that the loan is going to mature in 45 days, emails get automatically sent out to the borrower to take corrective action, either to extend the loan or to pay it off. All of this just goes into creating efficiencies and managing a good loan portfolio. And then communication with investors. It's important to be communicating with your investors and letting them know what's going on in the marketplace. So if you guys ever have any questions about the portfolio, if you're invested or not, feel free to reach out to me or my team, and we'd be more than happy to answer any questions for you. Looks like a couple more questions came in. Why take the risk of expanding into another market that isn't your expertise, even if you acquire to do so? So really, at the end of the day, as you bring more investor capital in, there's only a certain amount of deal flow that you can do. So if you're, if I find that I have a lot of cash drag because we've kind of saturated the San Diego market, that's when you start to consider other marketplaces. Are these notifications to borrowers FCI driven or TaliMar driven? It's TaliMar. Well, so FCI does send messages out. How good they are, I have no idea. I do not depend on FCI to service essentially in person or communicate with the borrower. Okay, it's really as the lender's responsibility to be that communication, contact that borrower. But the emails that go out from our standpoint are coming out from our system. FCI does have kind of some of their emails as well. But we want to understand what's happening with the borrower more than FCI is going to be able to provide to us. Okay, so fund structure. I'm going to just blow through this slide real quick. TaliMar Income Fund I, we're structured as a mortgage REIT. One of the things I wanted to talk about is how do we calculate returns to the investor? So I talked about that the weighted average coupon, the average interest rate of the loan portfolio is a little over 10.1%. So the fund takes out a 1% servicing fee. So if the portfolio is earning 10.1%, the fund or the portfolio of loans, the fund is earning a net 9.1% before expenses is 9.1%. That is how our fund, one way that we make money. So we take a 1% servicing spread. If you invest in trust deeds, you're probably very familiar with the spread. We structured it this way because a lot of our trust deed investors were familiar with this kind of layout of the fund. So we just take a 1% servicing spread. The other thing is that we don't take an administration fee. And there's a big difference. Yes, it's a percentage of the portfolio, but if the portfolio isn't paying, if that loan is not performing, I don't get paid on that loan as a part of my servicing spread. Okay. If it was an administration fee, yes, I get paid no matter what, no matter how good the performance of the fund is, I get the administration fee gets paid. We don't have that. So we want to ensure that the portfolio or the loans that we're putting in the portfolio are going to perform. And then the majority of the income we make is from the points or the fees we charge our borrowers at close. That averages around 1.5%. It may go up to 2% or a little higher, but I think we're averaging right about 1.5 is the fee that we're charging the borrower. There are no loads to this fund, and I think that's a common question we get to. So there's no loads on the fund as well. So back to that idea. So we take a 1% servicing spread on the portfolio, and then there's some costs associated with doing the accounting, doing the fund administration, audit work, and all that. And I'll get into what those costs are. Target yield for the fund is 8.75% to 9%. Year to date, we're about 8.8%. Distributions are monthly. You can reinvest those distributions or you can deposit those funds in your account. Talk about the management fee. It really should be loan servicing fee is 1% loan servicing fee. Leverage, yes, we use leverage. I think the balance on our current line of credit is 0. We haven't tapped it in a while, but again, that's just used to manage inflow and outflow of capital. And then our expense ratio has probably actually gone down because the portfolio has grown so much, but it's about 0.35%. What's an expense ratio? That's just, again, what we're having to pay for the audit work. None of that comes to us as any form of profit or anything. It's just what we have to pay for audit and tax, or not tax, but accounting and other type of work and fund administration. Okay, we got a couple more questions coming in. Is the 1% in addition to the 0.5% of FCI charges? Good question. FCI doesn't charge a straight 0.5%. They actually, I think it's $15 to $20 per loan that they charge. But yeah, we incur that. The fund I'm sorry, TaliMar Financial incurs the charges for the servicing of the portfolio. So that 1% covers that FCI charge. Does the fund share in origination, late, and extension fees? Loan origination, again, are the fees that we charge the borrower at close. The answer is no. Late fees, yes, but FCI takes 50% of the late fees, and the fund and TaliMar take the other 50%, and then we split those 50-50. So the fund would get 25, TaliMar gets 25, FCI gets 50%. And then extension fees, yes, of the extension fees, TaliMar gets 75. When I say TaliMar, the GP gets 75, and the fund gets 25%. One thing I do want to highlight is the lender portal. So one of the things that we talk about is being as transparent as possible to our investors. That's why we offer a portal that you can log into and view the loan portfolio in real time. And this is kind of what it would look like. So this is my account in the mortgage fund. So you'll see my balance right here, a little under 825,000. And up in the right left-hand corner, you're going to see mortgage fund, the tab. So there you can log in. You can view the portfolio overview. So everything we just talked about, the number of loans in the portfolio, I think it actually just changed, but 72 loans, all of this is in real time in our database. So it's reflective of what you see in the investor portal. As of date, so we'll talk about investor returns. We'll go ahead and post what they were last month. We just came out, that was the phone call from our fund administrator to discuss the returns for this month. And then we'll go ahead and update the investor portal to show what the returns were. This breaks down all the portfolio by loan type, by property type, by state. Now we only do California, so I was thinking about changing this more to county. So we'll break that down by county. And then ownership type. For those that, what ownership means is, do we own the whole loan or not? Now, we only focus on funding the whole loan. We own 100% of the loans we fund. There's just a number of loans that we had investors that were doing one-off trust deeds. They wanted to invest in the fund or transfer their ownership interest into the fund, which is why we have a couple of we'll show fractional interest in a loan. And so those will burn off here in the next quarter as soon as those loans pay off. And then the other thing that we do is we actually disclose all the loans that are in the portfolio. So you can go under mortgage fund, go to loan schedule, and view all the loans in the portfolio. So write down, including city, state, property type, loan type, balance, LTV, ownership, rate, and whatnot. I know the first one is going to show a lower lender rate. We still have some loans that we funded last year that are still in the portfolio, and we're just waiting for those to burn off. That's why they're a little lower rate. But most of the loans that you're going to see, kind of where you see that 9.5, 9.5, 9.5, 10. So that's where you're going to see a lot of the rates falling in here. Don't worry about trustees. This is kind of for our legacy trustee investors. And then one of the things that we do is education. So I post a lot of content on YouTube. Feel free to check out my page, my personal page on YouTube, and then the company page as well, content on where the market's going and whatnot, and on our mortgage fund and other stuff. And then here, you can go into the documents tab and you can view all the documents. So you can download the financial audits for last year, the private placement memorandum we post here, fund an example of the or template version of the subscription agreement. One thing I forgot to mention is we are now approved on the Fidelity and Charles Schwab platform, so that you can now invest through your Charles Schwab or Fidelity account. And we can walk you through that. So no longer do you have to use a self-directed IRA custodian like Forge or another company, though you're more than welcome to do it, but you don't have to do it. You can invest directly through your Schwab and Fidelity account. And we posted the forms that you would have to use, and we can help you through the process. It isn't simple. And again, for those that are on the call, We so appreciate the flexibility going through Fidelity and Schwab. It is not an easy process, but I think we've dialed it in, and we are getting the time it takes down to manage to work through that process. And then we post the third-party accreditation form. So just real quick, you do have to be accredited to invest in the mortgage fund, and we'll provide you a couple of ways you can become accredited. Accredited is you have a net worth of $1 million or greater. And then we also post the wiring instructions. So I'm going to continue here. Actually, we got a couple more questions coming in. There's a 1% servicing fee to fund origination. Do you feel the fact that FCI? I imagine this individual has experience with FCI. Do you feel that FCI, being the fact that they get half the late fees, is it in their best interest to let payments fall behind? Maybe. I'm not going to speculate. I'm not the grassy knoll guy. But does the loan servicer allow payments to go late because they earn income from the late fees? We're already taking a look at the late fees. So we know from day one of that month who hasn't paid, and we're already communicating with them. So for example, we had no late payments. In fact, we didn't have a payment that went beyond day 11 for this month. So we're on it. Does FCI do it? I don't know, but I don't trust that the people that are, or that they're in best position to ensure that payments are made on time. But I like that idea. Do they actually do it on purpose? I do feel like sometimes they you know what, they're a great vendor, and I would never badmouth them, but they are a big organization. They're number one, probably one of the biggest FCI or biggest servicing platforms. And I know a lot of great team members over there. So I'm happy with them, but I do know the limitations that they have. Is the portal generated, integrated by Verivest, or is it a TaliMar proprietary software? So this is probably an existing investor. Verivest, again, is a fund administrator, and they have their separate investor portal where you can go and get your monthly statements on the mortgage fund. We don't post that on the TaliMar portal. Why? Because we don't have access to their accounting systems and all their systems. We don't have access to. So you would go to their portal to get the statements. Simply what we're doing with our portal is just to give you some insight into the performance and health of our mortgage fund. So the software that drives the TaliMar portal, our investor portal, is all developed in-house. We have a team in India that I work full-time with that is constantly enhancing, building out the software. In fact, it's actually integrated with FCI now. So if a borrower makes a payment towards FCI or servicer and it bounces, it comes back as NSF, it actually triggers our system to send an email out to, again, the borrower and all our loan servicing team to let us know that a payment has bounced. Same with payoffs. So we can know immediately if a payoff occurs because it gets triggered by their system. It gets triggered on their system when a payoff occurs, FCI's, and then it notifies our system, and then the email goes out to all the parties that need to know. Okay, another question. Have you ever pair off subordinated sleeves of big projects in order to make larger originations? Have you ever pair off subordinate? I think the question is more related to, do we share loans with other lenders due to the size of the loan? So if we had like a $10 million loan that we really liked, we could somehow put subordinated interests in that loan, or maybe not even subordinate, but everybody has a certain interest in the loan. The answer is no. I don't care to share loans with other lenders. You know, how I service loans is probably very different than how other lenders service. And I just don't want to be in their sandbox, nor do I want them in my sandbox. So we're going to own 100% of our own loans. And if it's too big of a loan for us to originate, then we pass it and go on. Does this apply to Fidelity 403B accounts? I believe yes. So we're working with an investor right now on a similar type account. And so you can use that kind of retirement account. However, I will have to get back to you at a direct answer. If you want to send me an email, actually, and I can follow up with you directly on that. Again, great questions. Keep them coming. I'm going to jump back to our PowerPoint presentation because we were really going over on time here. All right, so here we go. So common investor questions. How much does management have invested in the fund? I have approximately $825,000. In fact, I'll have it this month when we post the returns. I reinvest my distributions every month into the mortgage fund. Can I invest through Schwab, TD Ameritrade, and other brokerages? Yes, we are approved on the Schwab, TD Ameritrade, and now the Fidelity platform. So you can invest in those platforms. Question came in, are we approved on the Vanguard platform? The answer is no. If anybody knows how we could, though I don't think they offer this kind of investment option, we'd love to. And if anybody has other platforms that they invest in, we'd be more than happy to try to get approved on their platform as well, like LPL, some of the other platforms that maybe are kind of market to more wealth managers. We can see what we can do to get approved on those platforms. Are all eligible investors eligible for the 20% 20% qualified business income tax deduction? We talked about that. Yes, all investors are eligible for the 20% tax deduction, and that's going to show on the K1. So when you get a K1 for the following year, it's going to show what income qualifies for QBIT, qualified business income tax deduction. How do I withdraw my funds? Common question. The process is simple. You would submit a withdrawal request, and then we'll go ahead and process that request. Now, I want to, one thing I forgot to mention is that we did waive the lockup period. So there's no lockup period. If you're interested in investing, you invest and you just say, hey, Brock, it isn't for me. We'll go ahead and allow you to withdraw your funds. What we just don't want it to be is a savings account for people that are constantly putting money in and constantly taking money out. That creates a cash flow issue for the fund. So we're being flexible in being, allowing or waiving the lockup period. It's just we ask investors to be prudent of their transaction volume. Just know, though, that even though we are an extremely liquid fund, there could be times that we become illiquid. Okay, when would that happen? Well, one of the biggest risks with a mortgage fund, similar to like a bank, is if you have a large number of withdrawal requests at any one time. And the way we're able to pay out or fund or return investor funds is really two things have to happen. Number one, you have a payoff of a loan. That's a liquidity event. Those funds get deposited into our bank account, and then we can process all the withdrawal requests. Or you have new investor capital that comes into the fund, and we can disperse investor withdrawals as well. So in a case that you don't have a ton of payoffs or a ton of new investor capital coming into the fund, it may take time to process your withdrawal. Now, in the past, if it's like a $50,000 or $100,000 withdrawal, we've been able to get it out very quickly. I mean, within days that we've been able to get the funds out. But if you're going to come in with a substantial withdrawal request, it may take time. And one thing I totally want to be transparent about, and in the private placement memorandum, is that we have up to 3 months to disperse your money. Okay, so we have 3 months to disperse that money. And if we can't disperse the money in a matter of 3 months, we have the option to lock up the fund. Why would we do that? Well, again, as I talked about, in order to disperse funds out, you have to have payoffs. What you don't want to do is be in a position where you have to start selling loans to manage your withdrawals. Because when you start to sell loans, you start to take losses. Okay? The value of that loan may not be, or the value of the loan on the open market may not be for the principal value. This is what happened to a lot of the banks that failed recently. So you don't want to be in a position to have to sell loans to withdraw investor capital. So I tell people that, look, we're liquid, but don't think that you're going to be able to get your funds out the next day. Just anticipate and look forward to the future. If you think you need to take a withdrawal, contact me. I can give you an idea of how long that it would take. Also, it's going to be based upon the number of requests in the queue. So it's a first come, first serve. Okay, first come, and then you're going to have to wait to get your funds out. How do I get started? So I just want to end this with the process to invest is simple. It's really kind of three main steps. The first is submit a new investor account setup form. It's all online. I can send you a link, or you just simply go to our website at TaliMarFinancial.com. And you can go under the investor tab. And right here, you can request the executive summary. You can get to the investor portal. This is the one we covered. You can start investing. So if you want to start to invest today, just go ahead and select start investing. Or if you want to add additional funds to the fund, you can use the start investing tab to add additional funds. If you want to get set up investing, you can also use the new investor setup form. So you're going to have to fill out a new investor setup form. That's kind of step one. Once you've completed a new investor setup form, we'll go ahead and complete the accreditation process. Most can kind of happen three ways. Number one, you can get a letter. We'll give you the template letter, but a letter signed by your CPA. You can show a net worth of $1 million or greater, exclusive of your primary residence. So you can't use your primary residence to get to your net worth of $1 million. The only downside to using this is that we do have to do a credit check. If the type of fund we are, you have to do the credit check. I know a lot of people say, well, so-and-so fund doesn't do a credit check. I don't know why they don't do it, but it is an SEC regulated requirement. They have to do a credit check. Or the third way is to show that you have a income greater than $250,000, and I believe it's 300 or 325 if you're married. So 250 if single, 325 if married. And you can submit your tax returns or any type of income statements to reflect that you have made that income for the last 2 years and that you're going to be in a position to make that for the current year. Once you've done the accreditation process, which usually takes a day or two, go ahead and sign that subscription agreement. If you're using a self-directed IRA, we'll help you fill out the form for your custodian. If you're going to use Schwab, Fidelity, or TD Ameritrade, we'll also help you through that process. Once you sign the subscription agreement, you go ahead and deposit your funds with the fund. Now, this is another question that comes up. When does the interest income start when I invest in the fund? Well, the interest income starts once the funds are deposited and then when we activate them, right? So they're going to go into a subscription account. And then once we fund our next loan, or if we had investor withdrawals, we're going to take the money out of that subscription account, place it in the operating account. And then at that point, you start to earn interest, and you earn interest as long as you're invested in the fund. It's not like it goes, if a loan pays off, that your money goes back into that subscription account. It doesn't. You earn income in perpetuity, or as long as you're invested in the fund. Why do we have a subscription fund? Well, you don't want a large amount of investor capital to be deposited and then activated right away, because it then lowers the yield, it dilutes the yield. So you just have a lot of cash on the in the account. It's not earning interest, and then it dilutes the return of the fund. That's why it goes in a subscription account. It could be all the way from a couple of hours to a couple of days, maybe up to 2 weeks that we activate the funds. If you're worried about how quickly we can activate the funds, just reach out to our investor relations team and we'll give you an idea of the timing. And that's the process. And then you start to earn income. Every month, you're going to be given a statement from Verivest, our fund administrator. They will send out your statement. And either the funds are going to be deposited into your account, or they're going to be reinvested into your investment. So real quick, why TaliMar Financial? Why is it that we feel that we are best in class? Number one, I have 15 years of experience investing in this very investment, in this very market. We've had a consistent track record of investor returns and return of investor capital. We've developed proprietary software that allows us to identify issues quickly and provide transparency to our investors. We rely on third-party subject experts to do the accounting, to do the fund administration, to do the audit, servicing, and whatnot. So we allow the experts to do that portion of the work. We're focused on originating good loans and in ensuring those payments are coming in on time. And then we focus on core urban markets with strong borrowers. And then lastly, education, accreditation, verification. It's really important for me that our staff is very educated, especially because this industry is so dynamic. You need to know what's going on. So they're constantly getting their accreditations, verifying all the data that we're seeing, and then educating the staff as well. And then management is invested alongside of you, which I think is most important. So I am personally invested in this fund. This is how I invest my capital. And so, I treat the fund like it's my own money, because it is. For more content stuff, if you're interested in learning more about the mortgage fund industry, real estate industry, follow us on YouTube. I've got my personal site. I usually put up a video or two a week. And then also our TaliMar financial site. I'm on LinkedIn. Connect with me on LinkedIn. I post a lot of great content there. Facebook and Instagram. Go ahead and post stuff there as well. So please follow us there. Definitely give us likes. If you like some of the content that you see, give it a like. That helps promote the content that we put out there and lets me know that people are actually watching it. And then go ahead and subscribe to our channels as well. So I want to just answer any more questions here. Let me get down to these questions here. Some sponsors have other or parallel products. Does TaliMar, or is this the only one offering? Yeah, good question. So yeah, this is the only offering we have. So a lot of mortgage funds, or a lot of fund GPs, companies like ours may have like a fund for construction loans, a fund for bridge loans, a fund for owner-occupied loans. This is our only investment. And then, so if you have a large redemption request, multi-months needed, does that take priority over subsequent small invest? Yes and no. So there is some flexibility on that. So we may say, okay, you've got a certain percentage of your investment back, and that will then allow us to disperse funds for another investor. But for most situations, especially the average size of the investment in our fund, it's going to be mostly on a first come, first serve. So if you have a certain dollar amount, or you have a certain amount of investors in front of you to withdraw your funds, you're going to have to wait until they get 100% of their funds withdrawn before you can get to your funds. Can you use income for accreditation? The answer is yes. So you can show 2021, 2022 income over that threshold, and then just sign a document stating that you are anticipating that amount of income in 2023. If you've got a large investment, would you take it from their subscription account as you have originations, or is it in pieces? Yeah, so it's going to be in pieces. So let's just say we have, let's say $5 million, and I want us to keep 10%, below 10% of our current fund. So we're going to take that out in chunks and disperse it as new loans come in. And it'll be calculated based on when each individual chunk is activated. And let me follow up on that response. The reason we don't want to take the full $5 million deposited in the account is because that dollar amount would significantly dilute the returns of the mortgage fund. So you only want to take out as much as you need at that moment. Now, if we're talking like 100,000 and we need 75 at 100, yes, I'll probably make a decision to just go ahead and activate the whole amount, because 25,000 isn't going to have it would have negligible difference on the return of the fund. And it's probably more of a pain for my accounting team to manage, 75 of 100 than just go ahead and take the full 100. And that is the life and day of a fund manager. And finally, do you have others doing originations with you in case anything were to happen to you, or would the fund wind down in that unfortunate circumstance? I get this question a lot, and it isn't a matter of the originations. It's more of the loan servicing that people have a question. So if I were to pass away and become incapacitated, who really takes over the mortgage fund? So Sarah's been with us for me for over 8 years and really handles day-to-day operations of the fund. She's fully in a position to handle any wind down of the fund. And that's what would happen. And most likely is a wind down of the fund. And as loans pay off, go ahead and disperse the investor capital back to investors. Okay. So that about does it. I blew way over the amount of time, but I think we had a lot of great content to cover and a lot of great questions that you had. A lot of you are asking, well, how do I earn $500? How am I going to do this? Well, we are running a special right now that if you invest $100,000, and this is for new investors and current investors, okay, that we will credit your account an additional $500. So if you invest $100,000, we'll go ahead and tack on $500 onto your investment, and now you're earning income on $100,500. So if you're interested in learning more about that, feel free to reach out to me. Here's all my contact information, or go to our website, download the executive summary, or if you're ready to invest, go ahead and select Start Investing today, and we'll go ahead and process your account. We have plenty of room. I think we've got a little over 14 million in our pipeline. That's not to say that we're going to fund all that 14 million, but we have over 14 million in new pipeline deals. That gives you an idea of the opportunity. So again, I just want to say thank you for everyone that's held on and watched this whole event or whole webinar. We'll go ahead and post it and for you to watch if you missed something or you weren't able to watch the whole webinar. And if you haven't got any questions moving forward, send me an email, and don't forget to subscribe to our YouTube channels. Thanks very much. Take care and have a great day. And I'll